Brad Williams, XL Prime. Effective rate versus nominal rate. Let me just explain it. When you negotiated this car loan, you negotiate 6%. That's the nominal rate. But part of the negotiation was because it's a fully amortized loan, you're going to need to pay compounded monthly basis. What does that mean? That means the 6% is going to earn interest on a monthly basis as opposed to annual. That's why they have an amortization schedule. As your balance decreases, you're still paying a 6% rate on the outstanding balance each month. And you can see the interest here, even though it shrinks, this is still multiplied times 1.06 divided by 12 because it's a monthly basis. That is the effective rate, that 1 year period. So what you do to compute the effective rate, you use another Excel function, and it's the effect function. What that means is it computes the effective rate, and you take the nominal rate, which is the 6%, and the number of periods. You have a 5-year loan, 5 times 12 is 60. Your effective rate is 6.180, but your contract rate is 6%. That's the impact of compounding. Brad Williams, XL Prime, out. Williams out.